Welcome to our finance tutorial. Today, we're diving deep into the world of coherent risk measures, vital tools for assessing financial risk in a consistent and reliable way. By the end of this tutorial, you'll have a solid understanding of what coherent risk measures are, why they matter, and how to apply them in real-world scenarios. So, what exactly is a risk measure? In finance, a risk measure is a quantitative way of assessing the potential future financial loss over a given time period. Simply put, it's a number that tells us how risky a particular financial asset or portfolio is. Now, not all risk measures are created equal. To be considered coherent, a risk measure must satisfy four key properties: monotonicity, subadditivity, homogeneity, and translation invariance. Let's break these down one by one. First, let's look at monotonicity. This property states that if portfolio A's losses are always worse than portfolio B's losses, then the risk of portfolio A should be greater than the risk of portfolio B. Simply put, higher risk should mean potentially higher losses. Next, we have subadditivity. This means the risk of a combined portfolio should be less than or equal to the sum of the risks of the individual portfolios. It encourages diversification, implying that holding a mix of assets will generally be less risky than holding them individually. The third property is homogeneity. It states that if you scale a portfolio by a positive factor, the risk should scale by the same factor. For example, doubling the size of a position should double its risk. Lastly, we have translation invariance. This property tells us that if a certain amount of cash is added to a portfolio, the risk should decrease by that amount. Adding a risk-free asset should reduce the overall risk. To give you a better grasp of these concepts, let's look at a practical example. Consider two portfolios. Portfolio A, consisting of high-risk tech stocks, and Portfolio B, consisting of low-risk government bonds. If Portfolio A is riskier overall, it should have a higher risk measure according to monotonicity. Let's now assume you have $100,000 to invest and are considering combining these two portfolios. If Portfolio A has a risk measure of 10% and Portfolio B has a risk measure of 2%, what happens when you combine them? According to subadditivity, the combined risk measure will be less than or equal to the sum of individual risks. In this case, it would be less than or equal to 12%. This illustrates how diversification helps reduce overall risk. Next, let's consider scaling. If you double your investment in Portfolio A, the risk should also double according to the homogeneity property. So if $100,000 results in a 10% risk, $200,000 should result in a 20% risk. Finally, if you add $10,000 in cash to your Portfolio A, the overall risk should decrease by $10,000 according to translation invariance. Now, let's look at some data to illustrate these concepts further. Suppose we have three portfolios: Portfolio X, Portfolio Y, and Portfolio Z. Portfolio X has a risk measure of 8%, Portfolio Y has 6%, and Portfolio Z has 10%. We'll plot these risk measures to visualize the comparative risks. As you can see, Portfolio Z is the riskiest, followed by Portfolio X, and Portfolio Y is the least risky. This visual comparison helps us quickly identify the risk levels of different portfolios. To test your understanding, let's go through a quick quiz. Question 1. If Portfolio A has losses that are always worse than Portfolio B, which coherent risk measure property applies? The correct answer is monotonicity. Remember, it ensures that higher losses translate into higher risk. Question 2. If you combine Portfolio A and Portfolio B, and the risk of the combined portfolio is found to be less than the sum of individual risks, which property does this illustrate? The correct answer is subadditivity. This property promotes diversification by combining risks in a way that the total risk does not exceed the sum of individual risks. Question 3. If you double the size of your investment in a portfolio and the risk also doubles, which property are we observing? The correct answer is homogeneity. This property states that scaling a portfolio by a factor results in the risk scaling by the same factor. Question 4. If adding cash to a portfolio decreases the overall risk by the same amount, which property does this illustrate? The correct answer is translation invariance. Adding a risk-free asset, like cash, to a portfolio reduces the risk accordingly. Congratulations! You've now mastered the basics of coherent risk measures. Remember, these properties, monotonicity, subadditivity, homogeneity, and translation invariance, ensure that risk assessments are reliable and consistent. Using these measures can significantly enhance your risk management strategies.